Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of August 25th, 2024. And joining us this week is Viper. Where the heck has this guy been, and who the heck is this guy on the show? It's been, I think, well over a month since Viper's been on the show for a myriad of reasons. And so we're going to spend some time seeing what the heck have you been up to, Viper, and what have you been trading? And we're also going to take a look back at basically a catalyst of a sell-off. So it was just a few weeks ago that we had a momentous shift down and sell-off in the market. You wouldn't know that by looking at the market today, but Viper and I are going to take a look back at, what the heck transpired from that Friday to Monday. And spoiler alert, it has a little bit to do with currencies. But before we hop to that, check out the link in the description below to our Discord. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You also find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So find us there, like us, subscribe, and if you can't find it, let us know, and we will get it there. But let's hop to this week's episode content. And Viper, I think we're gonna tackle this in the reverse order of how I actually introed it. So we do want to hear what you've been up to, but I want to cover this giant stock market drop that happened. I was actually returning from vacation when a lot of this stuff started to unfold on a Friday. So I was actually flying in the air while the market was kind of coming to its close and things were just kind of dumping. And I was kind of scoping it out. And then it got worse before it got better, particularly on that Monday open. But you kind of look closer to this because I think you were not on vacation and you were not, dreaming up in the clouds. So what do you know about what went down around there?
Yeah, I mean, I'm surprised. I feel like in the air you'd still feel the ground shake. So yeah, it was. I mean, I guess you could use the phrase black swan event, but yeah. So basically, the BOJ, the Bank of Japan, the Fed of the Japanese banking system. They came out and said they were going to raise rates. That's obviously not new news. The concept of that is not new to anybody in the U.S. and Europe and basically around the world. But that is particularly distressing to come from Japan, and they were only going to raise them 25 basis points, so 0.25%. Which is like nothing, right? I mean, we went through back to back to back 75 basis point hikes back in the beginning of our quantitative tightening. But that is particularly problematic coming from Japan for a number of reasons. But yeah, I guess we'll get into that in just a second. But I guess first let's just jump in and take a look at what happened. And so the first chart that I have up here is the NIKKEI. I don't know what that stands for. I did and I forgot. But that is the Japanese market index. And so you can see it started coming undone Wednesday, Thursday, and then Friday, and then into Monday, just massive crash down over 20% out of that market. And similarly, so because, as you alluded to, I was very active on late Friday, and in particular, I had just started looking into Forex, so trading fiat pairs and whatnot. So it just so happened then that I took a look here at the USDJPY, which is the US dollar, Japanese yen, and it was dumping as well. And for Forex, like for a forex pair, like I mean, a percentage point is a pretty massive move in a quick go. So, and you can see that ended up unwinding. I think this is like 3%, 5% almost. The red line was just when I started paying attention. I actually jumped in on a short on this and just forgot in my, as many of you know, involvement in 24/7 markets. Forgot about the little rule on forex that these things close, and so I had a position open after close on Friday, and I was like, "Well, I guess we're holding this." So that ended up proving to pan out very quite well for me because when the market opened Sunday night here in the U.S., it just started dumping. So that went pretty well. But the interesting thing is, why in the world does that also trigger the SPX and the American stock market? I mean, we gapped down on the daily chart. We gapped on Friday and then massive gap down on Monday, and that is what you were observing there. Just kind of checking in on Friday, and then on Monday, like that was an 8% dump on the SPY on the S&P 500. So what the heck does that have to do with us? Like what? So um, it's interesting because I mean, and there is absolutely zero, as with anything we talk about here, zero expert knowledge or whatnot. This is just again our interpretation, our understanding, and as we navigate these waters and these markets, we're learning, just plain and simple. So a lot of this I had no idea existed before that day. But you know, that's the beauty of what we're doing here is just getting out there, diving in, learning and experiencing. And that's just kind of a plug for what we do here at Blockhead Traders. But um, what I then came to learn is there's this thing called the carry trade. And it actually makes sense given my involvement in various, whether it's blockchain protocols or whatever, just you know these various lending protocols and things like that. Um, it actually clicked for me pretty quickly what was happening, which was an interesting, just personal reaction, I guess. But there's a long history, which is very interesting. Not what we're going to get into here, but there's a long history with the Japanese markets and the history of Japan when it comes to the Japanese markets. But what is most important to understand is there was a boom in I believe it was in the 90s, where they were booming. No, I'm sorry. I think it was in the 80s before the black market crash or Black Monday crash. But regardless, there was a big period of boom. Then there was a big bust in the Japanese markets. And then coming out of that bust, the Bank of Japan, the BOJ, wanted to inspire market activity and they wanted to get liquidity flowing. And so they reduced their rates basically to zero. And then at times they actually went to negative interest rates. And they wanted to get people to borrow money, to spend money, to stimulate the economy, as they say. And it just wasn't working. There was kind of a lot of hesitancy. You know, I mean, I guess as you could imagine from any financial collapse, that people aren't ready to just go out and spend. Like they just got whacked across the face. So, but there are people around the world, institutions, other banks, other countries that do want to take advantage of zero or negative interest rates. So, what ended up happening was instead of these loans being taken out by the citizens, it was kind of a global thing that as countries were raising rates, and I believe this is now we're in 2010s, kind of going into rate hikes at post 2008 financial crisis. So countries around the world are raising rates, and Japan is holding zero or negative rates. So what is a bank to do but to go take loans from the best rate available, which is in the Japanese yen, And so you would take out a loan, millions, billions, whatever, for zero or negative interest percentage, then go take that money and just go invest it wherever you want. Invest it in your own U.S. market. Invest it in the European market. Put your money where the yield is that you're chasing after, and you're not you're not paying interest on that loan. So win-win around the board. And so all good things must come to an end. If it's too good to be true, right? So what we're seeing now is Japan is saying, and part of this, the reason they were able to hold zero or negative interest rates is because they were actually in a deflationary time with the Japanese yen. So that's an important point too. They weren't fighting any wild inflation or anything like that. So fast forward, there is inflation that they're battling against, and so they want to raise rates. They announce a rate hike of 0.25%, and the rest of the world goes, hold on a second. I borrowed a lot of money, and now that's going to change whether it's margin or liquidation or just my yield is no longer profitable to hold these positions. And so then this great unwinding starts to happen where, as you can imagine, if I borrowed $1 billion from the Japanese bank and then took that yen and put it in the U.S. market, now I need to sell those assets in the U.S. market, return the loan. Thanks for the fun times. And so that's kind of where we're at. That's a summary of how we got here, and it's interesting to me. Like, I mean, there were a lot of experts say that we're not fully unwound, especially because the BOJ kind of pulled back. They walked back their statement within like 2 or 3 days. They were like, "Oh, hold on a second, actually." Not going to raise rates if y'all are going to misbehave like this. If the market is going to be unstable, we are not going to raise those rates. So at this point, not raising rates. But it was interesting, and a lot of experts are saying that it's not done as far as the unwinding effect. And for a whole bunch of reasons I don't fully understand, but I've started to learn. We don't even have a full grasp on exactly how much money has been borrowed. Is it $14 trillion is a number that's kind of thrown around, or $20 trillion in the global scale that could come out of markets in the event that it's no longer profitable to hold those loans. So at the end of the day, that's what, as I understand it, and what's going on. So I don't know. Like I said, to me, carry trade was a brand new thing, though the concept, because of what I've been doing and dabbling and experimenting the last 2 or 3 years, the concept of it was very familiar to me, but I had never heard about it on a global scale. So I don't know how your experience has weathered you through that, as far as if you've were aware of the practice, or if you're kind of flying by the seat of your pants learning as well.
Yeah, so I'll say it's been a learning experience for me as well for a lot of parts, but I won't say surprising in many. Like, it's things I read about or heard about. So back, many episodes a year ago, I don't remember when it was, and we were talking about arbitrage on decentralized exchanges, where one exchange has a rate of this, and then you can do your transaction there, but then go do the transaction in reverse in another exchange because the arbitrage is in your favor. This type of thing stood out to me as, oh, this is like when a trader or somebody goes to another entity that has a lower interest rate, borrows a bunch of money, goes and invests it somewhere, gets the yield they want, and then they return the money. So it's kind of like an arbitrage opportunity on a big grandiose scale. What I enjoy or like about this particular event is it's very reminding about how intertwined and tightly coupled as much of this distributed global system there really is, and how a chain reaction will ensue from any sort of of major event that could spark somewhere. And I think this is kind of the crux that I think is important to take away from this event as a cautionary tale that no matter how sunny the skies seem or rosy the picture is, there is basically a domino effect just below the surface waiting to kind of knock down to some sort of potential nuclear bomb explosion. Now, we didn't quite get there, but what I mean by that is you have a bunch of these traders or a bunch of these carry and trade investors that say, "Oh my gosh, the interest rate is going up a little bit. I'm going to owe a ton. I need to start selling some stuff to cover this." Okay, so that is your first domino falling. That's the first thing in the chain reaction. And then what that shows is, okay, now there's selling pressure. What happens to selling pressure? Price goes down because you got so many sellers, they're overwhelming the market. You don't have enough buyers. So that drives price down. Then people see price and like, "Oh my gosh, price is going down. Should I sell too? I probably should sell too. I'm going to sell too." And you get kind of this indiscriminate selling. Well, then what happens is once the selling pressure becomes so great, now you got other accounts that are like, "Nah, I'm cool. I'm just going to hold it." Oh crap. Now price is so low, I'm getting a margin call because they've leveraged their account so they don't have a lot of buffer to suck up this type of this drawdown on their account. So now their brokers are saying, "Hey buddy, either you drop in a couple, more dollars or you need to start liquidating it." Maybe they don't have that available capital put in there because they're just over leveraged. They've run up all their debt. So now they're forced to liquidate. Now we've got more sellers coming out there. And you basically just get this massive panic selling that stacks upon stacks upon stacks and just drives it down. And then the bigger those drops become, now you got more people turning their heads going, "Oh, wait a minute, something might be happening. Do I need to sell? All right, I need to sell." And it just is this chain reaction that just kind of goes. And I think it's good to be reminded of that fragileness. And that's, one of the reasons in my account and with my trading strategy, I try to always keep a buffer for this margin expansion, because when margin expands, and that's the other thing, these margins that these brokerages use, they're based on volatility. And so when volatility increases, they say, "Okay, guys, I know I told you we only had to have 30% of your funds in margin, but things are pretty volatile, so I'm upping the requirement to 50%. And that's totally within their rights of operation when you sign the agreement. And a lot of people look over that, right? And they just think, "Oh, this is going to be my margin requirement." But in times of volatility, they up that. And this particular crash was crazy because I believe the VIX actually spiked up to the level of the COVID crash. Now, the price drop didn't go as deep as the COVID crash, but the volatility index did. And that index is what drives the margin requirements. So now, we're deep into this chain reaction, and the brokers are going, "Oh my gosh, the market's getting more volatile. Up the margin requirements." Well, guess what? Now those people that had, they were safe on margin, now they're getting margin called because the margin requirements just changed. And so that's where I think this was super relevant.
Yeah, that's a good point, because the VIX, that volatility index, the VIX spiked so hard. It was one of only 3 times that it has ever spiked that high. One was Black Monday back in 1987. One was COVID in 2020, and the third time was just now, where the VIX. I mean, I at one point I saw it. I think we were talking in the Discord with one of the other VIX maxis, maximalists that's in there. That I think I recall it spiking at least to 140, maybe a little bit higher, which is absolutely absurd.
Yeah. So just to to frame it, right? The volatility index, usually when you're in like the 20s and 30s, that's considered very, very volatile. I think for the bulk of this year, we were like in the teens, the upper to mid teens. And selling premium is really difficult once you get below 15.
So here's a question. I mean, you were mostly traveling, so your hands were largely tied. But had you been, and this is Friday and or Monday because the VIX was going wild, and a lot of your option strategies are just, I mean, that's your Super Bowl. That's your that's your The final granddaddy of it all is when VIX is spiking, that there's so much opportunity for your strategies. Were there plays that you wish you had made, or at least if you just imagining you were actually watching it live happening, um, are you confident that you would have struck on something and actually been able to capture a play on it?
I'd like to think yes, but in reality, I don't. I don't know. And the reason being is because I honestly didn't think it was going to stop and rebound as quick as it did. I really did think that that was going to extend deeper into the week, and so I think I would have been hesitant to sell something in anticipation that the price was going to drop a little bit more because um, I I wouldn't. My strategy wouldn't be to try to sell calls, right, and capture on the downside move. It would be wait till the fear is at an all-time high and we likely have stopped declining and then start selling puts at that point. And I didn't believe on Monday that it was going to turn around as fast as it did. And by the end of the week, we were almost right where we were when the week started. So, um, no, I don't think I would.
Yeah, and that kind of touches on that emotional aspect of it's really hard. It's hard across the board, and I guess that's one thing in these events. And as we talk about them, and just our general trading experience in general, um, and this is why we say it's so important to be in the market, but capital all caps BUT. um, Risk mitigation and risk tolerance is absolutely critical. And so what I mean by that is you have to be in to feel how real and sometimes paralyzing the emotions can be. But you shouldn't be in where you get paralyzed or crippled because you did something wrong. Um, and this is kind of an example of that. There's so many sides of the coin. There's not just two sides of the coin. It's multiple sides. Where on the side is what you talked about, with people selling and panic selling and like it's going. I got to get out. Um, and on the other side is the opportunists that know what to do. You know what the play is, and even if you're seasoned and you're not panicking, you're also not jumping in because there's still the fear there of the unknown. And I'm not saying you should fly without that fear, but I think it's just interesting and always worth calling out when those emotions are in play because it's you can't prepare for it. You just have to be in it and feel it. And the most you can prepare is to make sure that if you really screw something up, you're going to be okay.
Yeah. One other thing I'd probably mention too is I'm actually more confident that I wouldn't have found a trade because my portfolio was pretty well fully deployed going into that Friday. I'd kind of set a bunch of things on cruise control because I knew I wasn't going to be around. And in that big crash, I didn't get a margin call, but my cushion that I had put forth on my account was nearly gone. I had about 10% of my cushion left. And I did pull additional funds to deposit in there just in case things slipped more. It didn't, but that's why I keep kind of this extra reserve away from my account. So yeah, that's another reason I couldn't have either.
Yeah, and I managed to grab a tiny little slice of something, but the fear, like I said, everything I just said about the fear of entering was still uh, so present. But I mean, leading up to this event, the Warren Buffett had hit an all not all time high, but a crazy high amount of cash on hand, and he had been doing that the weeks leading up to this. I'm not saying it's directly connected, but also, I mean, if anybody can test the waters and know what's happening, I mean, who else? But I had seen that, and I mean, it's like he was up to 25 or 30% cashed up in his portfolio. Had dumped a ton of Apple stock, was one notorious one, but I mean he sold across the board. And so having my finger on that pulse, me and my tiny, 0.00001% of his net worth, I was like, you know what? Maybe I should have some more cash on hand.
Yeah, that,
So
that
I
that's
did
kind of
have
a
cash on hand.
it's kind of a good call out, actually, because I think this whole thing reminds me of his words. Be greedy when others are fearful, and be fearful when others are greedy. That we've talked about on this show. But I think that state of the market of overvalued potentially also fuels this selling. Um, you mentioned back in the stock market crash of 1987, and that's an event that was very, very similar to this one, where there was some policy events by government, the United States government in that case back then, that were occurring over the weekend. And there are groups out there that insure brokers, insure portfolios, stuff like that. And they were running on computer models. And the computer models were basically forecasting a ton of selling due to the regulation and finance rule changes that were being proposed and voted on in the legislation in the United States at the time. And then there was another factor to this where the policies and processes of certain mutual funds were written in a way that said, oh, hey, if you buy into this mutual fund, we'll go ahead and honor Friday's price of close over the weekend and on Monday and stuff like that. And so when a lot of this portfolio insurance stuff came out, brokerages started, trying to say, hey, we got to start covering some of our losses here because we don't have enough cash reserves to fulfill all of the forecasted sells that are coming from people that want Friday's prices, because if this much selling happens, the prices are going to be a lot lower. And there was just tremendous amount of selling pressure that drove it down. But the market, I mean, it was the biggest market crash, I think, since 1929 in the U.S. side, at least on a percentage basis. And the market stayed depressed for, I think it was almost 2 years after that before it caught back up to that level. But I think that piece of the market had already been kind of, people were talking about, oh, it's overvalued. And it's almost like everybody's kind of just looking for an excuse to sell. And I know the Japan carry trade piece was very similar to that. There's a lot of people saying, well, it keeps going up, so let's just keep buying. It's kind of weird. Things are kind of expensive, but, I guess we're going to keep growing. And then as soon as something starts to shake that foundation, it's just a domino in the chain.
Yeah, absolutely. And the last thing I want to call out is let's keep in mind mechanically and in reality, despite the dump, despite the recovery, nothing changed under the surface. Like this was an announcement of a rate hike and then a pullback of the announcement, and nothing ever actually changed. And so, I mean, if anything encapsulates emotions, it's that. Certainly there were definitely legitimate unwindings for protection from large institutions. But I would, I'm not even going to throw a number out, but I would say a very large chunk of that was just the emotional reaction to the news. And if I point to anything as proof of that, it's the fact that nothing changed.
Yeah, for sure. Well, anyway, Viper, enough about that topic. What the heck have you been doing for the past month and a half? Have you dabbled in the markets? Have you dabbled in cryptocurrencies? What have you been doing?
Losing money.
It's because you haven't been on the show. This is where we learn successes. You went off on your own.
But it's a twofold tale. It's that education tuition piece that we talk about. So what I've been doing is it's interesting in how it correlates. So I've mostly been I've been doing my equities DCAs, and I did ramp up a little bit more on the investment side in equities. Some various tech stocks that had gotten well knocked off and then wanted to get in. No active trading over there, but giving it more attention for that investment side of things. But one of the things, as I kind of alluded to, talking about the carry trade stuff in Japan, and we've said many, many times on the show, um, you know, while the hard hat disclaimer, and I would say that there is no, there is absolutely, like, nobody should be rushing into the cryptocurrency space or blockchain space or anything like that because of how wildly volatile it is and whatnot. But one thing we've consistently said about that space is how I don't want to say humorous, but just how interesting it is, how well it mimics real mechanics, and it does it at breakneck speed. Which is, again, as I alluded to with the carry trade situation, I was like, oh, once I understood the mechanics, I was like, yeah, I've seen that 1,000 times, and it always pops. Like that, it creates a bubble, it pops, and in the crypto world, it pops within a month or two. Like, it doesn't take years and years because everything is accelerated and exaggerated with rates or whatever. But I say that to say what I've been doing was, I'm just going to call it hitting the hard knocks gym, which is practicing, which is where I go in a particular account that it's maybe in total 1 or 2% of my portfolio, but it's in a particular account that I can basically scalp, day trade, and move very quickly in and out of positions. So I've mostly been in there, just working on my price action trading, price levels and all that sort of stuff. And the reason that I say tuition piece or whatever is, I mean, there was, I generally don't make money in that account, but I also can generally hold steady, and I kind of fluctuate up or down a little bit, because, again, I'm using it from that perspective of practicing. And it's a lot harder to practice in equities or something like that because either the vehicles are way larger and require way more capital or margin, or the liquidity is just not as fast moving. So I've been in there hitting the gym, practicing, doing that. But I think that time has come to an end. Because, it was going well. I mean, not profitably well, but it just, again, those emotions and things, you need to be self-aware when you're doing any type of trading, whether it's scalping, whether it's the options plays, whatever. There's emotions across the board. So I have very much recognized a level of confidence I've never had before on charts and jumping into plays and jumping out of plays and whatnot. But it's coming to an end because I goofed and I foofed it up. And in that account, again, those things that are like real life things but happen on a exponentially faster scale. Leverage is one of those things, and liquidation is one of those things. So I had a position open. It was highly leveraged, and again, this is why I play with a small account. And I thought I closed said position. It was up. It hit a particular level. I thought I closed it. It did not close. I moved on with my day and got focused back and doing real life tasks. Only to come back like an hour or two later, and it was all gone. I was liquidated.
So it did close.
So it did close. It did, and I made a nice little donation to the powers that be of the University of Liquid HU. So that's a cautionary tale, as well as in the grand scheme of things, with talking to the carry trade and whatnot, seemed applicable. And the reason why I'm shrugging it off is because of that. Everything we talk about, the risk mitigation, the risk tolerance, and I'm not rushing funds back in to replace that. I feel very confident with what I gained from it. It was juggling knives. It had high risk, and I got cut. So we deal with that and move on. So going forward, though, am going to be trying to plug this newfound confidence into some other plays. Maybe some more swing trading in equities. I would might see how the investment side goes and see if I can take a little breather on and just kind of do some of that. But yeah, ultimately losing money, but gaining that muscle memory is a very real thing.
Yeah, I mean, I can relate to kind of those moments where you're like, oh man, that really stinks.
Yeah.
Um, I know one of the best cures for that, aside from, just kind of framing it and the risk mitigation, everything is, as you kind of get back in the game per se, stick to something that works for a spell. Build up a couple of little quick wins and stuff like that. I know I went through a period of a lot of experimenting of stuff, thinking, "Oh, I'll try this strategy. I'll try this strategy," and none of them really panned out. And I know I've talked about it on this show, and I went back to the bread and butter of my volatility selling on certain criterias. And sure enough, tick by tick by tick, I started, notching the win, the win, the win. And it really helps with that psychology. Not saying you need to do it for the wins, right? But it's for the money that comes with the wins, I should say, but more for the psychology of building it back up. It doesn't sound like you're too torn down, but I can say that is a nice piece of medicine.
Yeah, for sure. And I mean, in the way that liquidations generally work, um, especially on protocols where price is very volatile, and especially in a decentralized landscape where the protocol is automatic, and so therefore the protocol is going to err on the side of protecting the user's funds who you're borrowed from. And so um, in the case of liquidations in that situation, you usually don't get 100% liquidated. There's like this little bit of dust left over in the account because it triggered the liquidation at a point where it knew it could get the funds back over. So to your point of getting those little wins, there's a tiny little bit amount of dust left in the account. I think it was like $40 or something like that. Um, and so just to help get over the emotional, because yeah, it sucks. Like you get in and a loss, especially a careless loss, is just it sucks. So I had that $40, and I was like, you know what? We're just gonna gamify this, and I'm not bringing any more money in. And let's see what I can do with $40. And just it started as just a fun like for the memes game, but to your point, like it started as I started winning and getting those emotional wins with it. Um, it definitely is reshaping value, and helping. Like it's not about the size of the wins. Like I closed the trade for $6 profit, like, and it felt like it might as well have been 6,000. Like because it was like there. See, I knew what I was doing. I could do it, and so I'm in some regards still hitting it a little bit just to see how that kind of helps mold and shape that perception, just to make sure um, I don't want to lose the confidence just for screwing something up fun of mechanically or logistically. So whatever it is though, in whatever arena, it's important to just get the little wins. Don't look at the monetary value, just like Sprocket was saying. Um, and it's those are the muscle memories that it's all connected and it all adds up to that moment when you see a massive opportunity, like a massive dump in the market. You have the confidence, whatever your mechanic is, to go seize it, but also not recklessly seize it. And I mean, I don't know. In my mind, it's all connected.
For sure, Viper. Totally agree 100% there. That brings us to the end of this week's episode. I thought you find it a little bit interesting, where we kind of dive into a little bit of that carry trade and that catalyst for that large sell-off back on August 6th. And, it's just kind of interesting to think about it. And I personally find it really fascinating how much of trading is really psychology related. Yes, there's mechanic underlying things that make it go, make it behave the way that it does, but a lot of the large reactions are more of the psychological response from people that trade. And so much, I think, of predicting trading patterns, predicting trading directions and stuff like that is really more about guessing what everyone else is going to do. Because I think that's why a lot of times where trends or patterns and stuff kind of work is because everybody recognizes those as a pattern. Therefore, everybody believes that if you see this pattern, this must be the thing that happens. And it's almost like a manifestation of the beliefs that occur. And it's not to say that it's all oogla boogla like that, but there is a large component of that. And I find that absolutely fascinating. And the events and things around like the 1987 crash and the most recent, correction in there really kind of exhibit, and you'll see hints of that stuff quite strongly. So yeah, I mean, it was great to catch up with Viper and some of the experimenting that he's been participating on. Maybe now we'll try to keep him a little bit more regular on the show, and he'll notch up a little bit more of those wins bit by bit, and kind of become, maybe driving a Lambo by 2026. Who knows? But for you guys out there, I hope you guys are finding your interesting trades, finding something that excites you in the market and keeps you interested, because time in the market is always better than timing the market, as they say. And it's certainly an interesting time coming up into the elections. Volatility is increasing. You got, overvaluation calls out there. So as one of my favorite quotes, be fearful when others are greedy and be greedy when others are fearful, holds true, as I'm a contrarian trader. So good luck out there. Hope you're finding things to trade. And remember, think outside the block.